My name is Jake, welcome to the channel. In today's video, I want to talk about controlling emotions. When I look back, when I first started investing, I think I struggled the most with controlling my emotions. I was kind of all over the place, right? If I saw an article that said, okay, the market's going to crash tomorrow, it really impacted me. And I could not stop thinking about, okay, am I going to lose everything? Or if I saw something where, everything was going great, I got really excited. And what I realized was it was kind of a roller coaster. When I first started investing, I really didn't have a grasp or control over my own personal emotions. And what I've noticed over the years is that this is what really caused me to have a lot of stress in my life, as well as also to have really diminishing returns in my portfolio. For those of you that follow the channel, you know that I haven't been investing in a dividend growth strategy for all that long. Back in May of last year, I transferred my Robinhood portfolio into my M1 Finance portfolio, what you see here on your screen. And about a year ago, I was researching and studying up on dividend growth investing, this kind of a strategy, and I was learning as much as I possibly could. I created this channel here on YouTube back in about June, the end of June, and really the goal of this channel was to help new investors interested in investing in a dividend growth strategy. Exactly what I'm talking about in every single video. And in this video, I'm going to share 6 ways of how I was able to control my emotions and really focus on what really matters, right? And so in this video, this is what we're going to talk about. I think Warren Buffett says it best that not everyone is capable or should invest in the stock market. Not everyone can handle the emotional roller coaster. And Warren Buffett really has great advice when he talks about this.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become.
One of my favorite quotes from Warren Buffett is, if you cannot control your emotions, you cannot control your money. And I think this is really, really true. I saw this in my own personal life over the years as I was trying different strategies. I noticed that I was really struggling to control my emotions because I was getting pulled left and right? With things in my own personal life, what were going on, as well as what was going on in the media and in the market. I think if you cannot control your emotions, you're going to have a very difficult time steering the direction of your investments. And when I think of a roller coaster, and when I think of people a lot of people that struggle with investing and controlling their emotions, it really, you see when people see their portfolio in the red and they see it go up and down, a lot of people react like this.
I've got to get out of here. I've got to get out of here. Calm down. Get a hold of yourself.
Stewardess, please let me handle this.
I've got to get
Calm down. Now get back to your seat. I'll take care of this. Calm down. Calm down. Get a hold of yourself.
Doctor, you're wanted on the phone. Everything's going to be all right, please.
All right, comment below if you know what movie that's from. All right, the very first thing when it comes to controlling your emotions is you have to have a goal. You have to have a vision, and you have to know where you're going. If you're investing in a dividend growth strategy, you have to understand that it is a process and it is going to take time. And I think Arnold Schwarzenegger says it best when it comes to this.
The first rule of success is to have a vision. You see, if you don't have a vision of where you go, and if you don't have a goal where you go, you drift around and you never end up anywhere. So let me tell you something, visualizing your goal and going after it makes it fun. You got to have a purpose no matter what you do in life. You got to have a purpose. So that's rule number 1, have a vision.
The second thing that you can do to control your emotions when investing is to know your history. Understand that market fluctuations, market corrections are very normal. And we've experienced these over the course of time. When looking back at the last 100 years of the Dow Jones, we've seen, ups and downs in the market. We've seen everything from the Cold War to the Great Depression to the financial crisis, and every recession is a little bit different. And you can't look back and say, okay, because of this, I'm going to forecast and predict the next crash is going to be like this. It really doesn't work that way. But I think it's important to understand, okay, what is the history of the market, and understand that it is actually a normal cycle for the market to go up and down. And by knowing this, you're going to be able to control your emotions better. The third thing that you can do to control your emotions when investing is use the media as a tool, but not solely for decision making. When I look back just here a month ago, I think the headline was we were going to go to war with Iran. And what was trending on Twitter and all over the internet was World War III. And we really thought, I don't know about you, but I really thought, okay, this is serious. I mean, this is actually going to happen. When Iran fired missiles and everything that transpired there, it was a very emotional time. A lot of people were talking, okay, this is going to take us into the next recession. This is going to cause massive market corrections. And then we've been still talking about this for the last weeks and months, is the coronavirus. The coronavirus, what is that impact going to be? A lot of economists are forecasting, okay, this is going to slow manufacturing in China, which is then going to have a domino effect across the entire global economy. And you're seeing articles left and right where you're seeing, okay, now we're, is 2020 going to be the market correction? Are we going to have a recession now? What is going on? And even, very popular YouTubers in Graham Stephan, for example, who are creating content and videos around this. I'm a huge fan of Graham Stephan. I think he has a lot of value and a lot of great content that he provides on his channel. But he also talks about this. And another one is Andre Jix. If you follow him as a dividend investor, I absolutely love watching Andre Jix. I think he has great content. He also talks about this kind of stuff as well. And so when you watch these things, it really can have a massive impact on your emotions. And so with that, you really have to understand, okay, use the media as a tool, but don't rely on it solely for your decision making. The fourth way to control your emotions is to embrace uncertainty and volatility in the market. And most importantly, avoid FOMO, the fear of missing out. I think I fell trapped to this as well, where you see something or you hear something that something is going to go up in value, and you want to get on that train, and you want to get on that train as quickly as possible. A few examples would be with Bitcoin, right? Bitcoin was trading back in 2015 just around $250. And then here towards 2017, it really popped, right? It went up to 18,000 and then it dropped again. And a lot of people right around this price point were jumping right in because they just heard about Bitcoin and they thought it would be a great investment. They bought in here right around 18,000, and then what happened? It just dropped dramatically. And it's been a roller coaster. It's gone up and down, but this is one example where you want to avoid this. You want to avoid going in and buying something at the peak, right? And then just have it just tomorrow just completely fall off. And that's the end of it. Another example would be with cannabis stocks. Cannabis was legalized in Canada back in 2018. And you could see, here this massive hype right before then that it just popped and, just blew right up. And then, here as the information is settled, it's just gone in the complete different direction. So a lot of people right at this point, they're like, okay, it's legal now. Everything is going great. I'm going to buy into it. They bought it. And then, now today they're down, 80% in some cases. So understanding that fear of missing out is real. Another example could be with Tesla. Now, I'm not here to say that Tesla is a good or a bad investment. What I'm saying is that right now the emotions are high, where it's at over $800, and just not even a year ago, it was trading just over 200. So a lot of people are seeing this and thinking, okay, well, I got to get on that bandwagon. I got to jump in, and that fear of missing out, it causes an emotional reaction in us, and we tend to make our decision making is often an emotional decision rather than based on the fundamentals of, is this a good investment or not? Once again, I'm not hating on Tesla. I think Teslas are great. I personally don't invest in them at this time. The fifth way that you can control your emotions is through proper diversification in your portfolio, and also in different asset classes. I've talked about different asset classes in my last video. If you're interested in that, you can go check that out. I'll leave a link in the top right. But what I'm talking about is having a portion of your money in a cash reserve, maybe an emergency fund. You could be invested into equities, like stocks, for example, US or international, as well as real estate. You could own physical real estate, or you could also own real estate investment trusts. I personally do both. I have physical real estate that I own down here in Austin, Texas, as well as I'm invested in real estate investment trusts in my real estate investment portfolio or sub account within M1 Finance. In my main portfolio here, it's just US based stocks. I'm only paying qualified dividends. So in my case, 15% tax on the qualified dividends that I'm getting from this portfolio. In my real estate portfolio, it's taxed a little bit different. I'm not going to get into that, but it is a little bit less favorable. So the way that I diversify in my own portfolio, when just looking at the equities in my portfolio, I diversify by sector. And I take a very methodical approach in how I have my target allocation set up, in which sectors I'm invested heavier in. For example, in consumer staples, I am invested into consumer staples for a couple of reasons. One, I believe that I have a better or firmer understanding of what these companies do. I'm not an expert in these companies. I don't know the ins and outs of every single business, but I do know what Coca-Cola does. I do know what Procter & Gamble is and how they compare to their competitors. I know what McCormick is. I know what Colgate is. I know what Hershey's is. I shop at Costco, right? I'm familiar with these brands. I understand them. But once again, I'm not an expert. So this is one reason why I really like the consumer staples sector. Another sector that I like is the technology sector. I believe that technology is a hyper growth sector. We're going to see continued growth in that space. And I do have some exposure to energy. As you can see, it's the one slice or one sector in my portfolio that is currently down. I am invested into ExxonMobil and Chevron. Those are the only energy companies that I own. I am also invested into healthcare. I'm invested into AbbVie. I'm invested into Johnson & Johnson and others, right? And so this is how I have set up my portfolio. And I get asked a lot, okay, well, Jake, can I diversify and have fewer holdings in my portfolio? And my response to that would be absolutely. This is how I personally do this. This is not financial advice. This is what works for me. I'm kind of a dividend nerd, so my hobby is researching companies, following up on companies. That is likely not going to be the hobby of the majority of the people watching this video, but it is for me. You can gain the exact same exposure or diversification through a low-fee, broad-based index fund or ETF. And you can also set it up by sector as well. Right? And so that is how I do it. Okay. And so this is how I have it set up. And this is how I am, what I've found is this is by having more diversification, I've been able to control my emotions. Now, once again, you can accomplish this with having half the holdings, right? In my portfolio, I have a little bit of it. I take an unconventional approach to my investing. And once again, I am a dividend nerd. This is a hobby of mine. I don't recommend this as financial advice. I have just around 90 holdings in my portfolio. 6 of these are low-fee ETFs that I've talked about on my channel. So I own about 85, just right around 85 individual companies. And you'll see in some cases, I'm down. Right? In some of my holdings, I'm in the red, I'm in the negative. And as a dividend growth investor who's investing for the long term, I actually get excited. I get excited that I see that 3M is down in my portfolio, because that means when I buy in to 3M again, I'm going to reduce my cost, my purchase price, my cost basis here, right? You see here right now, I have a cost basis of $256 and it's valued at $245. So the average share price of my tranche where I purchased is just over $168. That has gone down. And so when I purchase into 3M again, I'm going to get 3M at a discount. So I actually get really excited about that. And I am up in some cases. When I see that Coca-Cola is up over 30%, I think it's great. But you know what, to be honest, I wish it would go down so that I could buy more. I wish that I could buy more. I have it at $45, and I wish that I could get it at a lower price. The same with AT&T. I bought AT&T just right around $30. It's spiked up, and I wish that it would go down. Another great example is AbbVie. AbbVie was really, really getting beat up last year, and I got an average price just last year of $73. And just this last week, it's spiked up over $90, right? If you go in and if you look at it, it's at $94. And as a dividend growth investor, I want to see that go down. I want to be able to buy this at a discount, right? Because by doing that, I'm getting a higher yield on cost. Currently, if you purchase AbbVie at $94, you're getting a 5% dividend yield. And when I purchased this at an average price of right around 70, I'm getting a much higher starting yield. I'm getting over a 6% dividend yield, my yield on cost. Okay. And so this is one way that I've been able to control my emotions. And a lot of this has been thanks to M1 Finance. For those of you that follow my channel, you know that I absolutely love M1 Finance. I transferred my portfolio from Robinhood back in May of last year, and I've absolutely loved it. The reason why I love it so much, I get asked this a lot, is yes, the fractional shares, you can do that now with other brokerages, but the dynamic rebalancing is really where I see the value of M1 Finance, where I'm building out my pie, I set it up, I set my target allocation, and I can easily change this, right? Let's say, okay, well, I want to lower my exposure to the consumer staples sector. Say I want to move it down to 15 and say, okay, well, I want to increase my exposure to technology. I could up that. And so you can change this. And if I were to do that, it would adjust the target allocation, and then my next investment, M1 Finance would automatically purchase the holdings in my underweight holdings. And that's what leads me into my the next way to control your emotions. Number 6, dollar cost averaging with automation. Not just dollar cost averaging, but dollar cost averaging with automation. And what do I mean by that? So dollar cost averaging, what it is essentially, you're putting in the same amount of money every single week, every 2 weeks, every month, and you're buying into the market. If the market goes up, all right, well, you buy at a higher price. If the market goes down, okay, well, you buy at a lower price. And essentially what you're getting is you're getting average market returns, okay? And for me, I'm completely fine with that. 99% of portfolio managers cannot beat the market. So I am completely satisfied with getting average market returns, okay? I think a lot of people can understand the concept of dollar cost averaging. Those that have a 9-to-5 job, that invest into their 401k through their employer, you're purchasing into your 401k or your Roth 401k every 2 weeks, and you're dollar cost averaging into that. I do the exact same thing, except I do it in my Roth 401k as well as into my individual account here in M1 Finance. And what I mean with through automation is I have automatic transfers set up every single week. Every week, I am transferring money into my portfolio. In my cash flow portfolio, this is my US stocks, and my real estate portfolio, I'm transferring a smaller portion, but also I'm transferring every single week. And this is what I mean with automation. So every single week, M1 Finance, so I'm transferring money from my bank account into M1 Finance, and then M1 Finance is then going to, based off of my target allocation, purchase individual companies in my slices, right? And so, for example, on February 14th, I purchased 34 shares. I transferred over $100, right? And so those 34 buys, I purchased 34 different companies at different price points, and also all in fractional shares. This is really the power of it, right? I'm not having to purchase full shares. Let me share with you how I used to do it with Robinhood. I mentioned that I transferred over from Robinhood. Let me show you how I used to do it. Before I went over to M1 Finance, I was using Robinhood. I've used TD Ameritrade. I've used E-Trade in the past. I've even used Scottrade before they were acquired by TD Ameritrade. And so what I used to do is I would track the performance. I would look, okay, what was the historical return? And I would kind of look, all right, what was the rolling average of the last 52 weeks? What's a good price? What is the price to earning? You know, all of that stuff. And what I would do is I go in and I'd set a limit order. All right, I want to purchase, just as an example, I want to purchase Tesla at 780, and I want to purchase 10 shares. All right, or whatever. This is just an example. And then I say, okay, well, do I want it just for today? No, I'm going to do it until it cancels. And I would do this for maybe 20 or 30 stocks that I had in Robinhood, and I would update the trade every single time. Okay, and I remember back in last year in January, the market was really low. I thought we were going to go into a recession. Right? I thought we were going to continue going down. So I put in limit orders lower than where they were at. And then in January, the market, if you remember, just completely jumped up. And so all of my orders, none of them went through. And so I was waiting months and months and months. And then none of my orders were going through because the market was just going up. So I wasn't buying in. I was just on the sidelines. And so this is how I used to do it. And I can tell you right now, my emotions were so high. When I was setting these limit orders, I was thinking, okay, I want to purchase this. I want to get a really good deal. I'm only going to buy it if it hits this price. And my emotions really, really took over. All right. And so today I do it very differently. I set it up. I have my transfers automatically going into M1 Finance, and it automatically purchases based off of my target allocation. And I'm buying into wonderful businesses. I'm not buying into penny stocks. I'm not buying into speculative companies that don't have a sound business model. I'm not buying into companies that are the market is as a whole overvalued, but I'm not buying into companies that have extreme overvaluations, right? I'm looking at, in most cases, more conservative blue chip companies like Disney, right? Or Caterpillar that most people have heard of. And one last thing here, what I love about M1 Finance, this is very different than with Robinhood. With Robinhood, I would always have to go in and make the manual transfer or trade. And with M1 Finance, when I get paid a dividend, for example, here with AbbVie, I got paid $15.80, and in my portfolio, I currently have sitting in cash $16.20. That is from dividends. And the market is closed on Tuesday, but on Monday, on Tuesday when the market opens, with my transfers as well as with the dividends coming in, M1 Finance is going to automatically purchase my underweight holdings with not only my transfers, but also the dividends that were paid to me from Clorox, from Colgate, and AbbVie, for example. Just like you can see here with Apple, Apple paid the dividend on the 13th. It hit my account on the 13th, just over $1 here. And on February 14th, my $100 transfer plus the dollar from Apple purchased 34 companies in my portfolio. Right. And that's what I mean with dollar cost averaging through automation. And I'm telling you, honestly, in my own experience, my emotions I have them at bay. When I was using my other brokerage, I don't know what it was, but just the actual manual process of clicking the limit price, the share price, and reviewing the order and executing every single order, the emotions just really took over. And with M1 Finance, it really is a seamless experience, right? And so that is the 6th way. And you don't have to just do it through M1 Finance to get that same benefit, right? of dollar cost averaging, having your transfers automated. You can do that with another brokerage. I've done it with another brokerage, and I see it now with M1 Finance, and I just get so excited because it works so well for me personally. All right, everybody, those are the 6 ways that I was able to control my emotions as a new dividend investor. I hope that this was helpful. If you're new to the channel, I'd invite you to subscribe, like the video, and I'll catch everybody in the next video.